All right, let me turn my air conditioning
I
unit
won't
off.
say anything bad.
Yeah, don't say anything back.
That ass this time.
Okay.
Because this is an important video.
Somewhat important. It's basically my forex strategy. And the reason I trade forex on the side is so I don't lose my mind.
Is
Um,
Forex like more predictable?
no. Nothing's more
No.
predictable. It's all the same. They're all different instruments and they all have their little nicks, okay? Here's the thing about forex, right? It's not like indexes where it just constantly trends up. You know what I mean?
Mm-hmm.
So if you zoom in and you zoom out, it will constantly kind of go up and down, right? So you could get into a position, and if it goes against you, you can kind of put more and more into your position because forex reverts a lot. You know what I mean?
Yeah.
It's not like a single country. Well, it depends obviously what countries you're comparing to, but it's not like a country is gonna fall. You know what I mean? It's very
Mm-hmm.
unlikely, and because it's so unlikely, you can make it to where your risk is really low, and you can make quite a bit of money. You know what I mean? You
Yeah.
just have to balance out how much money you're risking and making sure it doesn't go against you too hard. You know what I mean? So you can stay in a position.
Yeah.
Um, so yeah, like you borrow money to make more, but at the same time you got to watch how much you're borrowing because you never know. It could just keep going against you. Like there was this one trade on USD CAD, US dollar to the Canadian dollar. Basically, if the dollar goes up, right, USD CAD goes up. If the Canadian dollar goes down, USD CAD goes up. Right, that's kind of how it works in a nutshell. You're just comparing the two instruments. You know that constantly. You know, if you go, have you ever like traveled across countries and had to use different currencies?
No.
Well, if you go to Europe or stuff,
But
they use the
exchange rates.
pound. They use the sterling,
Yeah.
whatever. They use the euro. So you kind of got to like exchange your money for that so you can have cash in there. But there was this one trade on USD CAD where I think I entered like a small position here and it went against me like unfathomably a lot, right? And there was this one dude that I kind of learned the whole idea from. He does YouTube. He lost like 40 grand in the trade cuz he was
Oh,
risking too
bro.
heavy. Dude, but I think like here, like his last trade, 40 grand's nothing to him. This last trade like he made 14 grand on the 24th. So, he's chilling. But basically, it just kept going against me. It kept going against me. And I just kept adding in until my average price was like really high up, right? And I was shorting this, by the way. I was short selling this. So I was betting that the US dollar would fall, and it did. You had to realize though, there's a lot of macroeconomic events like Trump getting into office.
Yeah.
That's what kind of steered it in weird directions and stuff, right? But I think that trade. Let me see. I think that was like my most profitable trade ever. Sell on. Oh my gosh! I just USD CAD, USD CAD. Yeah, I made like I basically like almost doubled the account on that trade. When it goes against you, basically you have the opportunity to make even more and more money, essentially. But so that's kind of I don't know. That's just like one scenario I wanted to share. But let's do these slides, all right? So, accelerated dollar cost averaging. And I say accelerated just because of how it kind of happens quite fast, like it's within days. It's not like months of dollar cost averaging in years. It's like usually you run a profit within a week, and in some scenarios you'll hold a trade for about a month. Usually not more. Um Damn, I wrote a lot in this slide. All right. Well, let me just read off of it, I guess. In this presentation, these are the terms I use to categorize ideas. Conception, subjective tool used to help visualization, helps build frame for a strategy. does not offer any edge. Okay, so essentially you can use as many indicators, you can use as many metrics and stuff, and while, sometimes it's right, and a handful of times it's wrong, it doesn't necessarily offer you any edge. The only way to apply and use an indicator or strategy is if you have intuition and context behind it. You know what I mean?
Yeah.
So it's like, I'm trying to give you an analogy here. You got to have context to the situation,
Like
right?
there's
If
something's
you're,
happening in the
yeah,
world, so you know
it's
kind of what's
just
gonna
like
happen.
the USD CAD trade, right? Everyone was shorting because all the technicals were saying to short because it was so overbought, right? But people didn't take into account that there was an election a month or like a week within 2 weeks, right? And that caused the
Yeah.
price of USD CAD to shoot up insane, and a lot of people just got tapped out of that position. While it was still true that it did go down, and that's why I still tried to catch shorts. You got to take everything into context and position accordingly, right? And essentially, this trade it doesn't really matter which direction you even choose as long as you just manage your risk appropriately. That's the whole idea of this. And then I categorized ideas as concepts which are objectively true based on history, something that can make a strategy reach its goal. Okay, I don't know why I said specifically history. It should be objectively true based on history and on current events. And then these are just like some stats. I don't know. This account I tripled, so this is kind of old, but the only objective I have in the financial markets is to build and protect capital. This is done strictly for a profit or to hedge against inflation. My goal is to play with risk in a way that preserves my capital and hopefully makes a profit by allowing for more reward in proportion to my risk. Markets move both up and down. If someone randomly entered a market, they would win 50% of the time and lose 50% of the time. A statistic is that over 90% of retail traders lose long term. It's ironic considering that most of these people actually do have an edge and have a strategy that is profitable longer term. They lose because they let their psychology throw off their profitability, causing them to cut losses too quickly and prevent them from going into profit, or to cut their profits too quickly and prevent them from running. Long term investors win because they develop a strategy working with their psychology in a way that allows them to accept that markets will go down sometimes. Up and down. Against them is what I should have said. Since they take since they take risks in markets that naturally go up and have a higher win rate going long, they complete their objective in financial markets. Does that make sense or no? It's a cluster fuck of words.
Yeah. So like, I know what you mean. Makes sense.
Basically, you know the phrase long the S&P 500, you know?
Yeah.
That works because you put that and lock that away in a vault, and you don't have any psychological, like, you can't make any bad psychological decisions to sell during bad times, and because you're risking an amount that you can lose, you know what I mean, and you're comfortable
Yeah.
with losing because it's basically non-existent to you, you're able to accept the risk and allow it to play into profit, right? Because risk is only temporary. uh yeah, I don't know. I think that's where I'm trying to come from. Okay, here's my conception. So this is an idea that isn't true every time, but it is true with context. Oh my gosh, right here. I'm literally talking about the same exact USD CAD trade. Now, I keep referring to this trade because it was like the trade that made me realize, hey, this like actually works if you just do it right. Buying high and selling low works until it doesn't anymore, which is why I categorize this idea as a conception rather than a historically true concept. It is crucial to avoid making impulsive purchases because something appears overpriced or undervalued. Instead, interpret a buy or sell signal as a chance to assume some risk in exchange for a possible reward, rather than a free one. Before shifting, momentum must begin to decline. The length of a trend can only be visualized by its historical probability of losing or gaining momentum at that price, not assumed. This is why a person cannot be tunnel visions on support and resistance, and instead must allow for a tolerable margin of error. That's big. This is USD to the Canadian dollar. This is currently one of the most anticipated trades of the year. People became very tunnel visioned and impatient, targeting this very strong resistance level. to the point where they disregarded that the market is trending upwards and disregarding the current political sphere with a new United States president coming to office. Currently, there is a large amount of people in drawdown, leaving them psychologically susceptible to close at a loss or to be forced to close at a loss. Currently on Forex Factory, there are only 8 documented short trades winning compared to 303 losing trades in the short direction. It is important to take all macro and microeconomic factors into consideration and structure a risk that has enough room to go into profit or to break even. That'd be kind of a worst case scenario. Well, the worst case scenario would be blowing your account. DCA, the way that ADCA works is that you only deposit the amount you're capable of losing. You double the account, you withdraw half of the account, and then from there you basically have an account that's risk free. That's what you want to do immediately, because there's always
Yeah.
the chance that you could blow the account. And I've noticed from time and time again, you can get to the point where you usually double the account before you blow it, and then from there, if you double the account, you basically have a free account to make as much money on. But you could also play it the more conservative approach. You could double the account, and then after you double the account, you stay with the same risk tolerance that you had with your initial deposit. So if you took 1 grand and turned it into 2 grand, you pretend like it's only 1 grand so that you allow for more margin of error. You know what I mean? You have more money
Yeah.
to risk, and
Limiting
that
loss.
that lowers the chances of you blowing the whole account. So every single time you make money, you're also saving money. It's kind of a weird idea, but it definitely works as I've done it. Dollar cost averaging, or DCA. Having these ideas in mind, how is it possible to create a profitable strategy on paper? Simply, it is possible to make a profit mindlessly buying and selling at given levels if you manage your risks appropriately and dollar cost average so small you have a very low chance of blowing an account and a very high chance of profiting or bailing out of a trade. Bailing out of a trade, I mean like if you're in a lot of drawdown and then it retraces just barely enough for you to get out at like a small profit or just no like very minimal loss, and there's macroeconomic stuff that you're scared of and stuff psychologically, and just maybe it'd be a good idea to get out because there's always another trade, right? Obviously, it is important to visualize the nature of a market before making decisions and macroeconomic factors driving price in a direction with a changing volume. I've proven countless times backtesting with previous historical data and on demo accounts that it's possible to turn a profit mindlessly trading in both directions as long as you structure your risk appropriately. Okay, concept price action. Okay, so this is where I talk about how and why I trade the instruments that I trade, and like the fundamentals of why I trade forex and nothing else. Price continues to have a higher likelihood to keep doing what it is doing. This is price action, by the way, which basically is just a smart guy word for how price moves. Um, and if price is in a downtrend, it has a higher probability of going down next candle. So, price trends up, price trends down because of just simply the way that orders are getting filled. This works long term and on like short term positions. You can see this in the price of gold from 1833 to the present. Historically, price moves up. Why would you structure a risk so heavy against yourself by shorting with 100% capital? The only way to guaranteed profit by shorting is to have an infinite amount of money in DCA. So essentially, and this might be a little bit of a weird way to think about it, if you could make money shorting gold for the rest of your life, right? But you would have to have infinite money. And why you'd have to have infinite money is just statistically gold just keeps going up and up and up, right? You'd be waiting
Yeah.
for that one retrace for you to go into profit, that really big retrace as you dollar cost average against like over and over again. Gold goes up, sell more. Gold goes up, sell more. Gold goes up, sell more. You're going to be getting put in more and more drawdown, more lose, like, you're going to have more and more lost money there, unrealized losses. But if you have infinite money or a really, really high amount of capital and a low risk tolerance, eventually that one retrace, I mean, like right here, I'm not sure what years these are because the image got propped out, but maybe this is like 2010, whatever this happened, whatever presidential term, whatever happened here, eventually you have that one retrace that put you into profit because you dollar cost average so much that your average price would be like around here, and you'd be able to bail out of a trade with not as much profit maybe as you wanted, but actually probably as much profit as you wanted, because you also have to realize your size so heavy, your position's so big, and you're trading with so much money. At some point, when you dollar cost average that much, that even like a small move like that is a pretty copious amount of money. Like, it's a lot of money. Because not only is your average price above the retrace, also your position would be like extremely large if you've been dollar cost averaging for a while. Dude, honestly, I start to lose my mind when my AC isn't on. Like,
Is it hot?
yeah, it's so hot.
I
But
know.
I'm
That's
afraid if I
bad.
turn it on, it's gonna screw up my OBS. Do you think it will?
Uh,
You know
who
what?
cares, bro?
All right, all right, all
It's
right,
your video.
all right, Chatterbait. All right, here's where I go into some more. These aren't really. Did I classify this as a conception, or this is a concept? I'm pretty sure. This is a historically true fact, and it repeats itself every single day, every time frame, every asset. Right? What is a fractal? A fractal is a geometric shape that exhibits self-similarity, meaning it appears similar at different scales. And like a popular fractal is the Mandelbrot set, right? Basically, I'm trying to say here is that price, no matter where you zoom in. Oh, Mexico cuts key rates by 50 points to 8%. Okay. Anyways, I can't leak the telegram. But basically, no matter what way you look at a chart, first of all, there's no way to identify what time frame you're looking at. So right here, on the left, I have a 1 day time frame chart, right? So each of these candles is a single day. So this is like a course of years over here, right? I'm not even sure how many candles we have, but definitely about a year. And on the right is a 1 minute. I mean, this is less than a day. This is like a couple hours, right? But you can't tell the difference. They're both charts. But what they're doing on all levels, on every single time frame, they're all doing the same exact thing. So if price is trending up, they're all going to be trending up. They're all going to be filling gaps and pushing higher. Same thing for if they're trending down, or in my case, mean reverting, like forex pairs. And let me read off this slide right here. Here's my concept. Price action is fractal in nature. It is doing the same thing on all levels, easily visualized with reduced noise. What I mean by that is that sometimes you can get caught up in narrow visioned and small little short-term downtrends, but at the end of the day, if you zoom out, you'll be able to see what price is actually trying to do. The only thing that changes on different time frames is the amount of volume and how fast momentum shifts. If I were to give someone two charts, one on the daily time frame and one on the 1 minute time frame, a person would not be able to tell the difference. The only difference there is the size of the candles. It is important to not change your bias in the midst of chaos and to be tunnel vision. Okay, alright, right here. Here's my concept. Forex markets are naturally mean reverting. So here is the US dollar strength index, which you can see, I mean, it has its periods where it goes up and down pretty drastically. But overall, it's kind of in this middle line here, and it kind of returns to this average. Due to the nature of their macroeconomic makeup, forex markets are naturally mean reverting in nature, meaning they move sideways. Combining this with the idea that price action is fractal, it is appropriate to DCA on low time frames with the structure of mean reversion. There are certain pairs that are better examples than others due to the way that the economies of countries are established. So here are two of like my favorite mean reverting pairs. New Zealand dollar to the US dollar, right? This is very mean reverting. You can see here that it's basically sideways the whole way. And then over here, AUD, or the Australian dollar to the US dollar, it's also very mean reverting. I think they're actually the same exact chart. I think I screwed up the slides, Jace. No, they're not. They're not the same exact chart. Oh my gosh, they're just so similar. Look at how similar the New Zealand and the Australian dollar are. That's why I trade the New Zealand dollar to the Australian dollar, because it's so damn mean reverting. It's insane. Basically, the US dollar dominates both of these markets, right? I mean, they move according to daddy, the US dollar.
Big Papa.
Yeah. Anyways, yeah, that's crazy to see right now. I don't know. I'm in a trade right now on the New Zealand, or wait, I'm in a trade, hold up. I'm in profit right now on AUD to NZD. This is one of like the most mean reverting pairs I know, just because of its macroeconomic makeup. Right now I'm in shorts and I'm up right now actually. Alright, there is more. Here's another concept. There is more volume in markets during sessions. Ooh, okay, so this is different. This is where I used to trade market sessions. And it's not like I still don't, right? But usually what I do nowadays is I open my trades before market sessions and I allow the market sessions to move the trade into profit or against me. And I'll usually fill more orders in during market sessions. But before the sessions, I will fill my first orders in so that I could catch the session move, and or during the session I could catch the main move against me. So, foreign exchange markets see more volume during key trading sessions. The New York sessions from 7 a.m. to 4 p.m. sees an increase in volume, and is a time that I am awake. I take advantage of this opportunity and trade the New York session. So I used to try to trade the New York session on a very small time frame, but I don't really do this anymore. I swing trade now. I still use Heikinaichi candlesticks. So Heikinaichi means average bar in Japanese. What are they? A type of Japanese candlestick that shows a range of price movement. It's calculated by the previous open and the previous close divided by 2. Essentially, it's like a candlestick, but it shows where like the average price, like it shows the average price of all the candlesticks, and from that average price, you could kind of see, hey, we're in a downtrend, right? It helps you filter out noise. So I use Heikinaichi candlesticks to visualize what the market is doing at a given time. If on a higher time frame Heikinaichi candlesticks show bearish momentum, due to the fractal nature of the markets, I can look for short opportunities on lower time frames. Yep, I still do this today. Simply buying out when a Heikinaichi shows reversions. I don't know why I said revisions, but reversions does not guarantee a profit, but shows that there is opportunity for high probability trades in a certain direction. Looking at a specific set of time within that candlestick. Yep, okay. They are a great tool for getting rid of extra noise and visualizing your gravity of a trend. Yep, right, that's very true. This was, damn, I remember I used to trade like this. This was really something, man. It's actually insane how much I failed to get to the point where I am right now. It's like insane. I mean, I've been trading now for so long. It's insane seeing how far I've come. What I used to do is I used to wait for an Heikinaichi candlestick to either get reverted or just for it to close under, and then from there I would look for shorts on the market opens, and I'd wait for the RSI on like the 5 minutes. It was insane. It really was something, man. It was going well until it wasn't. The thing is about trading on these lower time frames is that you have to trade with such a big size that you don't have that much margin for error. And that's the thing that I take into account on long-term swing trades. I wasn't thinking about the margin of error and how price could really just keep trending against me to the point where I wouldn't be able to do it. I thought I could do it on profit firms, but I really couldn't. They don't really allow you to trade like this. I mean, it's possible, but it's really hard. I recommend just opening a live account with an unregulated broker or regulated, whatever, and take the long swing trades. Okay, right here. Here's a conception because it's not it works. It's not historically true every time, though. You have to apply context to this. But the RSI indicator, the relative strength index, it's a great tool for visualization. Like I state here, a common misconception is that they are a magical tool that can be used for guaranteed profit over time. Anytime historical data proves that they are profitable, but the ever-changing market conditions prove them to be unprofitable long-term. Hindsight is a lot easier to trade than current market data. It is up to a trader to interpret the data they are painting for themselves appropriately, given market conditions, and adapt with what they see. Usually an uptrend has a big jolt up towards the end to fill orders before it reverses, and RSI helps visualize this. Here are some. Here's an example of how RSI doesn't work every time, but here's a great example of how RSI does work. Right? You have to add context. You know, maybe there was a macroeconomic event, and we wouldn't have taken that into account, and we'd be in drawdown. Which still, I mean, you can still make profit. You just have to size perfectly. Okay, and here's I talk. I don't know what I'm on about here, but this is not what I need to worry about. So this was, I was going through a tough time here trying to figure out how to use prop firms for this, but you don't necessarily want to use prop firms. I'm not going to discourage anyone; it's still possible, but I wouldn't recommend it. And yeah, I kind of get a lot of inspiration from Nick Sean. That's where a lot of this comes from. So, yeah, I don't know. Good luck, Buttercup. Make some money.